Hello friends. So far I have discussed about profit and loss appropriation account. Right, we have discussed some practical problems on profit and loss appropriation account. Now we will start with the partners capital accounts and the partners current accounts. See, in the very first class I told you about the business entity concept. Okay, so what it is, the business entity concept says that the business and the person who are running the business are separate people from accounting viewpoint. That means accounting for a partnership firm is done separately and accounting for its partners will be done separately. So far the P&L appropriation account we have discussed from the partnership firm's point of view, that it is accounting for partnership firm. Now what will happen is that the partnership firm will prepare the partners capital accounts also, partners account basically. Okay, in its ledger the partnership firm will prepare the partners account. Now we have to prepare this partners account. We have to get the balance in partners account, that whatever the initial balance, capital balance of the partner is, whatever we are giving the partners as appropriations minus whatever we are charging from them like interest and drawings, and what is the net balance in the partners capital accounts. Okay, clear? So now what we will discuss is, we'll discuss about partners capital accounts. Okay, in this we have two type of accounts. One is fixed capital account and the second one is fluctuating capitals. Now what it is, fixed capital is that the capital what the partners have introduced in the beginning is fixed, it will not be changing. Okay, so what will happen in the fixed capital account is that the capital that the partners have introduced in the beginning, or the capital which the partners introduce in the middle, that will be shown in the partners capital account. And the other transaction means the transactions from profit and loss appropriation account will not reflect in the partners capital account. Then where will these transactions go? If these transactions are not to appear in the partners capital account, then these transactions will appear somewhere to get the partners balance, right? So what we do is, under the fixed capital accounts we prepare two type of accounts. One is the partners capital accounts and the second account that we prepare is partners current account. Okay, what we do under the fluctuating capital means that the capital that the partners have introduced can change. Okay, so here we have only one type of account, that is partners capital account. Okay, clear? Now I'll show you the format of these partners capital and the current account. First I'll take the case of fixed capitals. I'll take the case of fixed capitals. Now what will happen in this fixed capital? We'll prepare the partner's capital account. Okay, let's say there are two partners, X and Y. Now, how will prepare the partner's capital account? Let's see. Just like any other ledger account, we'll prepare the partner's capital account. We have credit side and we have the debit side. We will have particulars. Here the partner's name X, Y. X and Y. Now let's see. We say that the capital introduced by the partners. Say each partner is introducing 1 lakh as the capital. Okay. So what we will do is, we'll say here we have a credit balance of capital. We always have a credit balance when the capital is introduced by the partners. We can have a debit balance if the drawings of a partner are more than its capital. Then we will have the debit balance of capital account. Remember this thing. Say, okay, so X and Y have introduced 1 lakh as capital. So in the partner's capital account, I'll say by balance brought down 1 lakh and 1 lakh. This means X and Y have introduced 1 lakh as capital. They have 1 lakh in their capital accounts. Okay. Now in the fixed capital, we say that this capital cannot change. Then where will the appropriations go? Appropriations like interest on capital, salary, commission, interest on drawings, profit or loss. Where will this go? Okay, so these capital balances cannot change. So in the partner's capital account, what I will do is, this capital only I will carry forward. I'll say to balance carry forward is the same, because we can't change. I'll tell you the circumstances where this capital can change. But here I am saying that X and Y introduced 1 lakh as capital and we are following fixed capital. So in the partner's capital account, the capital will remain fixed. If it is 1 lakh, it will remain 1 lakh only. We can't change it. Now what we will do is we'll prepare one more account that we will name as partner's current account. Okay. So all the transactions will take place through partner's current account and not through the partner's capital accounts. It is very important to remember that under the fixed capital accounts, we prepare two kind of accounts. One is the partner's capital account, where the capitals will remain fixed, and the second is the partner's current account, where we will enter all the transactions relating to the partners. So we have the partner's current account, credit side, debit side, particulars. Okay, say partner X, partner Y. So now the partners will have a separate balance in their current accounts. We'll write that balance by balance brought down. If it is a credit balance and if it is a debit balance, we'll say to balance brought down. Okay. So it is very important to understand the concept. Fixed capital says that we cannot change the capital. Okay. So we say, okay, we won't change the capital. In the partner's capital account, we introduced 1 lakh each as capital and we carry forward the same capital for the next period. Now, how we will account for the transactions? That we will do through partner's current account. Partner's current account says we have a balance, either credit or debit. Now remember, while preparing the P&L appropriation account, right, we discussed a few things. We discussed about profit, then we discussed about interest on partners' capital. Okay, now interest on capital, interest on partners' capital is an income for the partner and expense for the partnership firm. Now if it is an income for the partner, we will show it on the debit or the credit side. If the interest on capital is a income for the partner, remember the journal entry. What was the journal entry? Interest on capital account debit, because it was an expense for the firm to partners capital or current account. So now we are preparing the partners current account, where we will show the interest on capital on the credit or the debit side. Partners current account is credited, so we'll show on this side by interest on capital, because it is an income for the partner. Clear? Very clear. Similarly, if the firm is paying any remuneration to the partners, say salary, so it is an income for the partner. We'll say by salary. Now if the partner is having any drawings, if it is having any drawings, it has a balance in partner's current account. Okay, it is withdrawing some money from this current account for his personal use. Okay, so this balance will reduce. We'll say to drawings on the debit side. Now if the partner is withdrawing money for the personal use, he has to pay interest on that money. That we call as interest on drawings. I'll say to interest on drawings. Now what we are left with? The profit that is to be distributed among the partners. Remember profit and loss appropriation account. We transfer the profit from profit and loss account. Okay, we add in that the drawings, subtract interest on capital and the salary. Then whatever is left with us is distributed among the partners as profit. Now that profit is an income for the partner. So we'll show it on the credit side. We'll say by profit and loss appropriation account, in bracket we'll say profit. Clear? So now we'll have the balance of this current account, partners current account. Balance plus interest on capital plus salary plus the profits that have been distributed among the partners minus any drawings and interest on drawings, will have to balance carried down. Okay, we can have what we can have this, we can have this balance on this side also. How? If the drawings, if the balance is debit or the drawings is more than the appropriations. Clear? So we can have a debit balance also. Right? Clear? So this completes our partner's current account. Clear? I'll explain you once again. Under the fixed capital method, it says that whatever the capital partners are introducing in the business will not change in the partner's capital account. So in the partner's capital account, we say that the capital introduced is 1 lakh by X and Y. We say balance brought down is 1 lakh, and because it is a fixed capital, we cannot change it. We say balance carry forward is the same 1 lakh. Clear? Now, how will we deal with the appropriations? We have to record somewhere to get the partner's balance. We have to record the appropriations, the money that is distributed among the partners, right? To get the partner's balance, we have to record that. So for that, in the fixed capital method, we'll prepare the partner's current account. We'll have either the credit balance or the debit balance of the partner's current account. And then we will record all the transactions of the P&L appropriation account, that is whatever we are distributing among the partners, like interest on capital, salary, and the profit left after all the appropriations that is distributed among the partners. Clear? Now we say that under the fixed capital, the capital is introduced by the partners and it cannot change. It can change. Now I say it can change. How? It can change only in one case, whenever additional capital is introduced by the partner. Initially, partner introduced 1 lakh each into the business. Okay. Initially, partners introduced 1 lakh as into the business as capital. Now they decided that they will introduce an additional capital of 50,000. Now what will happen is, I'll say by cash or bank. Because I am introducing capital, we have to debit cash or bank and credit the capital account. I'll say 50,000 and 50,000. Now what is the balance that I will carry forward? Now I'll carry forward not 1 lakh, I'll carry forward 1,50,000. Now I'll carry forward 1,50,000. Okay, so the fixed capitals can change only in case additional capital is introduced into the business. There's one more point. Here they are introducing the additional capital. There can be a case when they are withdrawing the capital. See, there is a difference. If they are withdrawing money for personal use, if they are withdrawing something out of their capital for personal use, then it is drawings. But if otherwise they are withdrawing their capital, withdrawing some part of their capital permanently, then this balance will change. Then what will happen is, I'll say X decided to withdraw the capital to the extent of 30,000. Now what will happen is, to cash or bank, because the firm has to pay this capital 30,000 and nothing here. So what will be the balance that will be carried forward? X introduced 1 lakh as capital, then 50,000 as additional capital, and then decided to withdraw some part of his capital, that is 30,000. Okay, what is the capital left for X? 1,20,000. And for Y, it remains 1,50,000. Clear? So I have told you, under the fixed capitals, the capitals will remain fixed. They will change only in case additional capital is introduced in the business, or in case the capital is withdrawn from the business, not for personal use. And all the appropriations to the capital accounts will be done through partners' current accounts. So in the fixed capitals, we will prepare two accounts, partners' capital account and the partners' current account. Now see, and what we will do under the fluctuating capitals. Now if we have fluctuating capital accounts, very simple, we will prepare simply the partners' capital accounts. Partners' capital account is what we will prepare. Partners capital account under the fluctuating capital is nothing but the partner's current account under the fixed capitals. So now we have the partner's capital account, we have the credit side, and we have the debit side. We have, say, two partners, X and Y. So now we have the balance in the partner's capital account. I'll say by balance brought down. What it is the capital introduced by the partners into the business, say 1 lakh. Now all the transactions, all the appropriations that we are doing in the P&L appropriation account will be done through partners capital account directly, because the partners capital can change now. Under the fluctuating capitals, we are not under the compulsion that the partner's capital cannot change. Okay, so all the transactions will be done through partner's capital account and not through partner's current account. So partner's capital account says interest on capital, income for the partner, to interest on capital. Clear? Salary, any remuneration, income for the partner, right? Drawings, that is money withdrawn for personal use, and the partner has to pay interest on this. So I'll say to interest on drawings. Okay, so and the profit being appropriated by I'll say profit and loss appropriation account. Clear? And after all these transactions, we will get the balance of the partner's capital account. We can either have the balance on the debit side to balance carry forward, or we can have balance on the credit side. Okay, so this completes our partners capital accounts under the fluctuating capital. See, one thing is very important in the exam. If it is not given that whether it is a fixed capital or a fluctuating capital, you have to always assume that it is a fluctuating capital, because this method is easy to follow. Okay, so in the examination, in the absence of any information that whether the capitals are fixed or fluctuating, you have to always assume that the capitals are fluctuating. Please note this down, that in the absence of any information that whether the capitals are fixed or fluctuating, you have to always follow fluctuating capital method. Okay, clear? Fixed and fluctuating capitals.